Let's get a global voice on this market. Steve Brice, Chief Investment Officer, Standard Chartered Wealth Management, is with us now. Steve, good morning. Thank you for joining in. And first of all, season's greetings. Wish you a very, very happy new year. Well, 2023 was a great year for the Indian market. As you see India from your vantage point, how do we look for the new year?
Yeah, I mean, we're still bullish on the Indian market. Obviously, if we look at the sort of macro picture, it still looks pretty supportive in terms of economic growth. So earnings growth is expected to remain robust. We see valuations as less stretched as they have been in recent times as well. It's obviously not cheap relative to many markets around the world, but less stretched than they have been. And also investor positioning is expected to improve. Obviously, domestic flows are pretty strong. And the international flows have been relatively muted over the course of the past 6 to 12 months. So from that perspective, we think the Indian market still looks pretty attractive, with domestic growth really driving the picture.
All right, Indian markets look attractive with domestic growth driving the picture. That seems to be the base case or the narrative for the last many months now, Steve. But how do you approach it sector-wise? I mean, do you have any preferences now in 2024? We're heading into technology earnings as well. How do you feel about that space? Or do you think banks could continue to take center stage?
Well, I think one of the things that's factored into our sector views is really what's happening. And obviously, we're in a pre-election cycle now. That's usually a good environment for stocks, just generally speaking. Obviously, the government is likely to make sure that the economy remains robust. So we're taking a bit of a barbell approach, actually globally as well, but also in India. So we're overweight consumer discretionary. We think the consumer story is likely to remain robust as we go through the first half of the year. Obviously, continued government spending is a positive there. Also on the industrial side, seeing incentives coming through for increased investment. That might only kick in the second half of the year, but that should be good for the industrial space as well. So those are obviously the pro-cyclical elements of the market. And then we are overweight healthcare at the global level and in India as well. A bit more defensive in nature, of course, but that sort of barbell approach we think should set investors up well for 2024.
Hi, Steve. Good morning and good to see you. Nigel on this side. Steve, what are you factoring in from the Fed? You know, it seems global equity markets, they're talking about rate cuts and maybe a little more than what could come about in the first half of the year. For the year, how many are you factoring in?
Yeah, so we're looking for around 3 rate cuts this year, but really, kicking in the second half of the year, right? So we still see, to us, the reading of the economy is, and obviously we're going to get important data today and obviously through the rest of this week as well, is that the US market, the US economy is coming in on a slower pace as we go into 2024. So obviously last year surprised on the upside, but we are seeing signs of that deceleration coming through. Together with this disinflationary trend that we're seeing, which is very strong disinflation now coming through, we think that is going to allow the Fed to ease monetary policy, even if they think the economy is not going into recession. Now, the risks of a recession grow, in our opinion, as we go through the year. But the first half looks slower, but still okay growth. So those rate cuts will probably only come together when we get closer to 2% on the core inflation measure.
Okay. Steve, the thing is, we're starting off 2024 on such a nice Goldilocks sort of with an outlook with Fed rate cuts, economy doing quite okay, and more foreign money coming in the market. That I keep asking all the experts that we get, please tell us what are the risks that we should bear in mind. I think geopolitics is a consensus risk that everyone talks about, but anything else that you would be a little watchful of?
I think the elephant in the room is still, do we get a recession in the States, right? So, obviously the soft landing scenario or that narrative has picked up a lot over the course of the past 3 to 6 months as inflation has started to come down. From our perspective, that does mean obviously that real interest rates are now going up quite significantly. So that is a tightening of financial conditions, which obviously is a headwind for the economy as well. So we're not out of the woods yet. I mean, if you look historically, a lot of the indicators that have a 100% track record of predicting recessions have been triggered. So it would be in some ways miraculous if the Fed was able to manage a soft landing. That said, as we head into the beginning of 2024, We believe that narrative is probably going to strengthen rather than weaken, which could lead to the S&P 500, for instance, going on and testing all-time highs. We wouldn't necessarily be confident at this stage projecting stock market gains through the second half of the year, but we think we're going to start on a pretty strong foot.
All right, we'll start on a pretty strong foot. Thanks a lot for that, Steve. Thanks for your thoughts. And once again, Happy New Year to you and your entire team. And hope you have a great 2024. Thanks for joining in.